Hi traders, in this video we'll be talking about how to mark institutional reference points. In the previous video we talked about how to identify the market's directional bias. Right now here we'll talk about marking institutional reference points. So the institutional reference points are simply your mitigation block, your breaker block, your liquidity void, fair value gap, order block, rejection block, old highs and old lows. I've done a video I've done a video on this institutional reference point. I've explained extensively what they are. So kindly go to this channel and watch those videos below for proper understanding, because I may not be able to explain everything here in this video. Alright, so now to mark your institutional reference point, first of all, let's go to the charts. So on the charts, the previous video we talked about market directional bias, and now we are talking about marking institutional reference point. We are still talking about using finding A plus setup using confluences. In the previous video, I explained market directional bias, and now we're talking about institutional reference points. So on the chart, so this is the current price action here. This is the current price action here, right? So what can you see here? For me, I can see, so institutional reference point already are things like your order block, your mitigation blocks, fair value gaps, and the rest of it. So now we can see that there is a fair value gap here, right? We can mark this one. This is a fair value gap. We can mark this. So I'm already marking my institutional reference point. This is a fair value gap, right? This is another block below it. This is another block below it. So you can see the moment price traded into this point, started going up. So you could take your trade from here. You could take your trade from here. Yes, you could just wait for your trade from here, right? Your stop loss here. That you've marked your institutional reference point. That is it. You've marked this is your institutional reference point. You've marked order block and fair value gap. I think we'll just base on order block and fair value gap for now. Okay. So now going forward, price has been trading up, down, up, down, up, down. And if you see here also, if you see here, there is also a fair value gap. Price mitigated it before and still went up again to mitigate it before dropping down, right? Okay, but already we are not looking for sell trade in this uptrend. We are not looking for sell trade. We know this is an uptrend, so we are looking for opportunity to buy, right? That is it. So now let's call this a market structure shift, right? And we see price retrace. Price came back. This is another block as well. This is another block. This is another block. Price traded into the other block and started going up. Did you see? So this is we're already marking like you can also call it zone, marking your zone or institutional reference points. So it's called institutional reference point because it's a point whereby institutions take trades. So whenever price trade into any of the institutional reference point, there is a reaction, either bullish or bearish. There is always a reaction. Okay, so going forward, this is also a break of structure. This is a break of structure here. Now we're looking for where price is going to. Okay, so this is a break of structure here. So we're looking for where price is going to retrace to, and now you can see that here there is a fair value gap. Here now there's a fair value gap here. This is also institutional reference point. There's a fair value gap here. Do you see? So you want to wait for price to come to this point before you buy. And this is the 4-hour time frame though. Now if we go to a more lower time frame, maybe let's see the 1 hour. Let's see the 1 hour time frame, right? So on the 1 hour time frame, 1 hour time frame is even more clearer because we can see that this is a low, this is a high, a low, a high, higher low, higher high. Now look at this. Look, this is another block, right? A reference point that has a small fair value gap. It has a small fair value gap here, right? So the moment you see this break of structure, break of structure here, then you mark your institutional reference point. You just take your trade from here. You can take your trade from this position, either from the fair value gap or the order block, and just put your stop loss nicely below this order block. Below, you may want to give it more space to breathe, and you just put it here, or even here, to give it more space to breathe. You can see how the trade will go nicely after marking your institutional reference point. Now going forward, you see going forward, you see another break of structure. Seeing another break of structure. If you're a day trader like me, like myself, I'm a day trader, so I'm a day trader, so after every reaction I take profit here. I'll wait for price to retrace again. I enter another trade. So now this is also another break of structure. Now waiting for price to retrace into another fair value gap. This is where we take our trade again. So this is where we are taking our trade again. So we can take our trade again now from this fair value gap, right? And our stop loss here. That is it. So just keep marking your zone. When you mark your zone or institutional reference point, it gives you the confidence to take trade from there. It gives you the confidence to take trade from there. You just wait for price to come to that zone or that institutional reference point to trigger your setup, and boom, you take that trade. So this is a fair value gap with another block. This is another block here. So putting your stop loss below the other block is the right place to put your stop loss, just a little below the other block. That is it. That is it for it. So this one also, so if we go down to a more lower time frame, we could see on the 15 minutes time frame, okay, so on the 15 minutes time frame here, right, so I can see a fair value gap here. There's a fair value gap here, right? Okay, with another block. He also has another block here. This one down is another block. So it's also safe to take your trade from here. It's also safe to take trade from here. You buy from here, and your stop loss is here, right? Now I can also see another fair value gap here again. There's a fair value gap here. So these are all marking your institutional reference point, and here we're just talking about order block and fair value gap. We've not even dived deep into other institutional reference point, but just order block and fair value gap. Now see here, so we could take our trade from here. We could take our trade from here. Buy. We could buy from here, right? So if you notice, we are not really trading blindly. We are not trading blindly. We know the direction of the markets. We know our directional bias, that is an uptrend, and now we are marking our zone to give us a point of interest. This is actually like a point of interest. This is, we're marking our zone. We wait for price to get to that zone before we take a trade. That's it. So this is simply how you can mark your zone or institutional reference points, and whenever price gets to that institutional reference point, you can take your trade from that position. Okay, all right, so thank you so much for watching. If you found this video helpful, kindly like, comment, and subscribe. See you in the next video.